This is our bull trade, stage one trade. It's very simple. Currently, or as of Friday, this is up.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
$1,480 with 35 days to expiration. We have an exit at when our September trade reaches 65 days to expiration. Okay. That's going to be this Wednesday. So this Wednesday, this trade is going to be closed regardless. We do have a stop out point at a $2,500 drawdown. That doesn't come until Russell hits approximately 2,050, which is extremely unlikely. Our level one, level two, level three traders are going to trade this as is. Like, this trading strategy wins approximately 75 to 80% of the time, depending on what type of time frame you're in. It has approximately it has a 1-to-1 ratio from maximum possible gain to stop out point. Right, so that's a number that you want to be aware of with your trading strategy. With a 1-to-1 stop out, you have to win at least 50% of the time. Realistically, you probably have to win this trade 65% of the time to be profitable, because it's effective, right? So you have a theoretical rate, right? Maximum gain of 2,500, exit loss trigger 2,500. But the reality is our gains, our average gains are not $2,500. They're actually more around the $1,500 range is where we are now. Our actual losses on average is slightly over 2,500. So you have like a $1,500 to $2,500 ratio. That means you have to win this about 70% of the time to be profitable. It wins 75 to 80% of the time most of the time, right? So that's where the profit comes in. And this is only assuming that you're maintaining a consistent size, which is the other challenge that people come with, right? So if I'm going to have a trading strategy that I'm going to trade completely non-subjectively, and it's going to win, and then it's going to have an effective win-loss ratio of about 0.6 or 0.7 to win to one loss, right? So we want to be aware of those numbers. That's going to give you a general expectation of your trading strategy. And this strategy is a profitable strategy, and it's been proven profitable since 2002 over time. Doesn't win every month, doesn't win every 3 months period, it doesn't win every year period necessarily. But over time, it makes money, assuming you're maintaining a consistent capital level. When you start varying capital level in a manner where you're increasing sizes with wins and then you lose once or twice, or you have a bad 3 month period or whatever, and then you're dropping size, it's not a winning strategy anymore, right? You're dropping size when you should be adding size, and you're adding size when you should be dropping size, right? Because if you're truly aware of what the strategy is doing, if you've won 18 months in a row or 24 months in a row, which does happen with the strategy, you're due to lose. You're due to have a bad period, right? And you should think about definitely not increasing size during that time frame. But the problem is that a lot of traders use emotions for confidence. The emotion is, oh, look, I've won 24 times. Now I'm going to use that to base my confidence level off of, which is what you should not be doing, right? That's amateur trading mistake. Your confidence level has nothing to do with how often you've won or how often you've lost. It shouldn't have anything to do with it, right? It should be whether you're trading well, whether your strategy is matching the marketplace, right? You're making good decisions. That's what the confidence level needs to be based off of. But when you base it off your P&L, or you have confidence-based P&L, what tends to happen is you start increasing your size like crazy, as the wins come in, and now you're due for losses and you're at this maximum size level. And realistically, you've won so often that you kind of forget in a way that you can lose. In other words, you're not thinking about, hey, if this trade loses the next 2 or 3 trades, what's my P&L going to look like? And what's that going to do to my mental capacity to be able to trade this at the same size going forward, in my financial capacity as well, right? So now what happens is you end up taking it goes through its normal cycle, right? It's 20 to 25% loss cycle, and then you drop your size, right? So you're taking your losses at maximum size, and then once it goes through its losing cycle, it's 25%, 30%, 20%, 25% losing cycle. Now you're at minimum size. And now it's going to take more trades to get this back to your break-even point. And what's going to happen is it's going to take a certain amount of trades to prove to yourself now that you're actually in a good strategy again. And you're going to start increasing size. And you're going to be at about maximum size when you go through your next cycle again, right? And this creates a cycle where you're either losing money, breaking even, or not really making very much. And that's just not where you want to go, right? So that's a very important discipline to build because all those disciplines, right? The discipline to like not gain too much confidence when you're doing well and not lose too much confidence when you lose, and to be able to maintain your position size, all those are very, very critical things to be profitable when you get subjective, right? To be able to vary your position size based off of opportunity, not what you made money last. To be able to vary your positioning based off of opportunity, not what worked last time, right? All of those things are not are going to be like all these lessons are going to be very beneficial to you going forward, right? So when you're doing this, I encourage you to that it's not to say not to increase position size, but increase your position size. Do not do it based off of how many times you've won. Rather, I would tend to almost do the opposite. Encourage you to increase position size when you've had like a 2 or 3 month cycle that's like really bad. That's when I would increase my position size. You're aware of losses. You are looking down financially. Maybe you're not feeling so good about it, but you're going to do what makes sense and maybe make a slight increase in position size at that point so that when the cycle turns, you're making more money. I would tend to avoid increasing position size just because I've won a lot. Now, like I said, this might go 2, 3 years without losing. That does happen, in which case you'd probably want to increase position size there. But when you increase your position size, always be aware of the loss and just say, look, if I have a bad cycle, I want to make sure that I'm very conscious of that, like imagine it playing out. I want to be very conscious of that. And I want to think about, well, if I have this bad cycle, is that going to cause, if I increase size now, is that going to cause me to reduce size? Then the answer is yes, then you shouldn't be increasing your size, right? You should be waiting it out a little bit longer until you can say yes to that question. And then that's when you can, or I would consider maybe increasing my size. Okay. So there's some very important lessons there that are going to benefit you later on as a trader. Anyway, this is doing well, right? So we're up 1480. We're going to exit Wednesday. We'll probably be at a profit. Then we'll go into the next trade.